Hey, it's Soleil, and this is episode 396 of the Orange Pill Investor. That is probably one of the best, worst bands ever. Uh, can you hear me now, Kevin? Or am I speaking to the void? I might have had a little bit of mix up. I was playing my music through the laptop audio before connecting it to my AirPods. So, somebody let me know. Okay, cool. Thanks, Buffalo. All right, so we're doing a little early roll. Tomorrow's Good Friday, so we can all take the day off. I see some people started their 0 DTEs a day early. Everybody, good luck with those. Appreciate it, y'all. Thanks, Kevin. What's up, Dak? G says, "Do you ever do any spreads in your portfolio?" Yes, I've attempted to do a couple of strategy ones, but it gets a little bit rough because even though they're like the most heavily traded ticker in the stock market or close to it, sometimes the bid ask spreads are a little dicey, especially out. No, not Strife. Um, Same principle, really. For spreads, I'm going to treat it like I do my poor man's covered calls, or if I'm selling 45 DTE against my covered calls. And let's go. I tried to put together a put credit spread. So something like this, I tried to put together, but chickened out because one of the most important things about an options trade is the liquidity. And you can see here that the bid ask spread on this is $2.60 wide on a $1,000 spread, right? So the difference between the two strikes, the 240 and the 250, I would be putting $1,000 at risk. And I don't I don't really like excuse me, the premium is not bad here, right? So approximately 0.17, 17% chance of success, or excuse me, of failure on this one. So as long as I'm getting paid 170 bucks, basically the delta times the value, then this is a reasonable trade, in my opinion. Doesn't guarantee that it's going to win, but I think it's kind of basically just using the Kelly criterion, the formula that gamblers use to decide whether they can be profitable over time. So I think if I place this trade 100 times, it would be profitable, like 87 out of 100, and then the 17 times that it was unprofitable would be fine because I'd make more than I lost. However, I'm trying to collect $197 here, and the bid ask spread is larger than the whole freaking amount I'm trying to collect. So this just makes it hard to do spreads um, when you have this large of a bid ask spread. So I've tried to do it a couple of times, and I know some folks will add like the call credit spread. So something like this. But I I can't imagine, this is basically a limited bullish position, but it's directional in the wrong way. Like if I'm bullish on Bitcoin and I'm bullish on strategy, I'd rather have the put credit spread side and, you know, maybe benefit from number go up. Whereas this one, the only thing I'm banking on is that the number stays down low, below my strikes long enough to capitalize on this. And with implied vol being, under 25, excuse me, the IV rank under 25, I can't really expect to benefit on either of these two trades, the put credit spread or the call credit spread, because implied vol is going to go down. Like, I can't imagine it's going down from here. It's only going up from here, which is going to make it harder for me to close either of these two at a profit. So even if I was bearish on the stock and I wanted to set this up, which I think is probably suicide, um, I would, Kelly Cartierina would be the same thing. So 0.22 delta, I would need to collect about $220. So I can't even get that. So this doesn't even make sense to me from a value perspective. It really doesn't make sense to me on a directional perspective since I'm bullish on the stock to begin with. And IV rank is down. So selling spreads in this environment doesn't seem the greatest. Now, I did add some debit spreads. I think I have the wrong account. Yeah. I got some call debit spreads that I was able to get filled, and these have been on for almost 2 months. And probably not the best environment to open these up in. Like, we were still kind of correcting from the November highs. So this would be a much better play to put on now, I guess. I'm tempted to dollar cost average into this a little bit. But again, let's see what the bid ask spread would be on the call debit spread out to, what did I have, September, right? So if I wanted to add to this position, and it does seem to make sense. Like, if this is a low IV environment, then it might be more advantageous to buy spreads than sell them. And this is 100 points wide, so this is a $10,000. But everything's flipped when you're buying. So this is like $10,000 that I could make, not necessarily 10,000 that I could lose. But yeah, so it's still not the easiest to get a fill. The bid ask spread on this bad boy is 85 cents wide, which is a hell of a lot better than the liquidity was on the 45 DTE options. So this would be a little bit easier to get a fill on. And let's see if I go to the 850. So the delta on that is about 0.09. Yeah, I don't know. These still might be a little bit expensive. Even though they're even though they're a hell of a lot cheaper than I paid than I bought them for to begin with. Yeah, so, kind of similar back of the napkin math. So if the delta on the mid, halfway point on this spread is 0.09, let's just use 0.1 for easier numbers. And the most I can make on this is 10 grand, then I would want to pay less than $100 for this to make like mathematical sense. Now, if you're still just super bullish and you have a crystal ball and you know the price is going to rip to all-time highs again in the next month, that could compensate for that. But I don't know if I can get behind this either. Just, it's still not going to be that easy to get this to fill. Like I might have to pay even if I thought 175 was a decent price, which I kind of don't, I might have to, walk this up to 185, 195, $2 before I can even get a fill. I'm not really sure how that would go. But I was able to successfully get some credit spreads on the Tesla position. Nope, not in this account. This one. Nope, not that account either. This one. Here we go. So this is a smaller account. This is just basically my allowance. And I had 2 grand in buying power. And I actually set this up on accident. I was trying to see if I could get um, a credit spread on strategy. And I was like, oh, wow, the liquidity is getting better. And I actually opened this spread up on Tesla by mistake. um, you can see that I'm as about just about as bullish on Tesla as I am on strategy as far as certainty that number will go up. I just don't think that Tesla will go up necessarily as predictably. Like we're getting Bitcoin adoption, globally, nation states. And so I think strategy is tied to Bitcoin, and it's just I'm pretty sure it's going to happen, faster or bigger or both. But what did what's my position here? I have the May 23rd. Okay, so I've had these open for a week. But yeah, so I went out here. I generally will go somewhere between the expected move, this little line, little orange red brick colored line here is the expected move for Tasty Trade. So I'll generally go probably not any greedier than the expected move, and generally, maybe between there and the 1 standard deviation line. You could go way wider and, you know, be a lot less risky, but you're gonna collect a lot less. Like if I tried to put this together, you can't get a large credit here. So you'd still be putting a grand at risk, but for a much smaller credit. But again, the calculation that I would use in like as long as I'm paying, actually, I wouldn't even set this one up in this current IV environment necessarily, not this trade, because I'd want to get paid more than 50 bucks. And this is only paying 37. So would I even place the trade that I have on today from scratch? Pretty much break even. So with a 0.17 delta, I would want to collect at least 170 bucks. And this is just over that threshold. So yeah, I'll throw in a couple of credit spreads for fun or just for teaching purposes. But if I had a smaller account, I think you're kind of pigeonholed into credit spreads or poor man's covered calls. So you're taking a little bit more risk. The reason I like selling covered calls is because as long as you buy a stock that doesn't go bankrupt, like even if it drops in half by 50%, you can still find a strike somewhere that will pay you some premium on it. But if I get this put credit spread wrong and Tesla expires below, $190, then I lose 100% of the money here. So spreads are like win or lose. It's like the roulette wheel. You're either going to win or you're going to lose. Whereas covered calls, your overall portfolio could go down 50%, but you're not out of the game because you still hold an asset that's worth something. If that makes sense. What's up, Buffalo? Let's see. You exercised your 220 call this morning. Now to see how long it takes to pay off the margin. Interesting. And did those expire today? 220s. That's pretty cool. So you can hear, but it was blanked out for a bit. Okay, cool. Appreciate it. Let's see. Howard Sir Knight, what are your thoughts comparing the IV rank of strategy with the IV rank of IBIT? Let me see. That's my. Okay, so that's off. So I shouldn't get screwed trying to check this out. So this is marketchameleon.com. Nice resource for tracking implied volatility. So IBIT for the last year, so November it pumped to, when Bitcoin was ripping, it pumped to 65. And since then, let's just say it bottomed out in February at 43, back up to 60. So I'm guessing their baseline is around 45 to 50, and it only went up about 20% in November. So Strategy's IV rank right now is 22. IBIT's IV rank is 63 right now. So here's IBIT's implied vol, 30-day implied vol chart versus strategies. So this is what happened in November for strategy. Compared to this. So I don't think IBIT's implied vol can compete really very well, but let's just check. Well, let's do it here. So if I was just hunting premium and wanted to sell a cash secured put for next week, and I just didn't care about getting a discount, I just want to see how much capital I have to put up to get how much premium. And it looks like I can get $100 putting up $4,800, which would be about 2% return on capital for the week. And if I wanted to go out to 45 days, and let's do somewhere between the expected move and one standard deviation, putting up about $5,000 in capital. Let's just say that every 50 cents is 1% returns. And this would be like 16% at the expected move. 15% at the expected move. And let's go back to strategy. I'm going to start with that one so I don't forget the numbers. So at the expected move, if I had to put up 300 bucks times 100, so 31 grand, 1% of that would be about 310. So this is 22% returns at the expected move, right? 3 times 22 would be 66. Oh, so actually it's no, it's more than that. 25%. Oh, yeah, that makes sense. 3 times 25 is 75. So you can get about 25% returns at the expected move here with about 20% call away value. And if I didn't care about strategy's upside and I just wanted to sell a cash secured put, I could get almost 4%, like 3.5% at the money here. So in premium terms, strategy's paying more. And I think that the upside is better for strategy as well. Let me do. Oh, I forgot to check what IBIT was at 45 days. So the expected move is about 10% call away value, maybe closer to 15%. So from $48 a share up to 55 is $7. And I think 380 was a little bit, yeah, that's about 20% out of the money as well. Yeah, but if we went 20% call away value here, that would be about $9. That would be like 57. Yeah, so with IBIT, I think that the upside is poorer. The premiums at the expected move is less, and the size of the expected move is smaller. So everything about strategies, selling premium at least, is superior to IBIT. Now the only use case that I had for IBIT, and I'm going to do it here for ease, would be like a poor man's covered call. Because with a poor man's covered call, you're selling premium, but you're also buying it. And those could potentially offset each other. So let's say I want to go to, that's not quite a leaps. So June. And I'm going to go down to like, yeah, 0.75 delta seems reasonable. That's only going to cost me 1,600 bucks, whereas shelling out the money for the shares would cost me 4,800. So I could get 3 leaps for the price of 100 shares at the 0.75 delta. And then if I want to put a poor man's covered call, I could go here and do, let's see, 40 plus 16 is 56. So I'd have to stay at least above the 56 strike to keep this safe. And so I'm shelling out 1,600 bucks. I'm collecting 100. That's about, is that 7%? No, sorry. Yeah, 7% of the purchase price. It's only about a 2% return on IBIT's price. But yeah, let's compare it to what we're spending it on. So that would be about a 7% return against the purchase price. And generally, the best case scenario is that I have to roll this every 2 weeks for 50 bucks. So buy it back for 50, sell it back for 100. Buy it back for 50, sell it back for 100. And let's see what happens if I try to do Poorman's covered call with strategy. Let's go June. I'm going to go to the 0.75 delta. Let's see what this is. That's close enough. Let me see. All right, 0.75 delta. I guess this is still not too bad. So it would cost me 31 grand. And 3 times this would be actually 40 grand. So yeah, so I can't get 3 poor man's covered calls for the same price as all right, hold on a second here. All right. Yeah, so this is going to be a little bit more expensive to buy it. So I could only get like 2.5 of these for the same price as 100 shares. But let's see. If I add 275 to 135, 375, 410, I got to sell at least the 410 to keep this safe. Let's see, 1% of 135, 135. Is that about 6? Yeah. So I can get a 6% return for similar strikes. Oh, that's a buy. Yeah, so it looks like with the poor man's covered call, I could get about a 6% return against what I'm paying. So slightly under the IBIT. So there's a little bit of a use case there. And with IBIT being so much cheaper, right? Somebody with a smaller account could do an IBIT poor man's covered call for 1,600 bucks versus a strategy poor man's covered call that's going to cost you 13.5. But again, I think there's much more chance of strategy hitting 410 a share by expiration date, meaning you'll maximize the trade, than IBIT hitting 56 by expiration. Yeah. So this was really the only use case that I personally found for IBIT where you could argue that it might be a little bit more capital efficient, because strategy, even in a low IV environment, strategy's option prices are just so high. It's just going to cost a lot to buy these things. Let me know if that answers the question. What's up, Emperor? Oh, so you meant the IV, the Tasty Traits IV rank. Yeah. So IV rank, that just means that it's the 62nd percentile of IV over the last year. but has IBIT not been around that long? So it's really only when did IBIT start? January 2024. All right. Well, for some reason, Market Chameleon is only giving me back a year. Or not, I'm sorry, not a year. Only back to November. So that's unfortunate. So we really don't have a much of a base case here to compare. Yeah, you have to use a little bit of nuance with IV rank because IV strategies IV is being compared to this giant ass spike right here. So this November 22nd was when IV rank was 100, and everything's being compared to that. So even these spikes that were, little spikes here, that you could get a little bit of extra IV out of these. They were still probably like 35 IV rank. So you have to kind of think about what is the IV history over the last year and maybe grade this on a curve. So without that November spike, this IV rank might be 35 or 45 or something. Let's see. So your math checks out, but how is the MSCR rank in the 20s while Oddbit is 60s on Tasty Trade? Yeah, I think it's just because um, IV rank is going to be kind of distorted until next November when this giant spike rolls off. This is kind of throwing off the weight of the IV rank. Buffalo, see, bought at 3,500 was worth 23K in November, 9K today. Needs strategy to go up about $3 to cover interest and sell calls on top. So worth 9K today. And so what's your strikes, did you say? The 220s? Yeah, so it sounds like those didn't quite work out, but you're in the ballpark, right? And now you can sell calls if you want to continue to lower your cost basis. Let's see how it rests. So the IV rank is against itself, not against something we can use to compare two names against each other. Yeah, exactly. I bet options started in October, November, so that makes sense. Thanks, Buffalo. All right, let's see what I need to roll here. Start with the main account. Just starting at the top. This cash secured put is expiring worthless, so I am keeping the $97. Did I turn that down? Yeah. $96. And so I'm going to take that buying power and I'm just, why did I just get two fills? All right. I don't know why I got two dings. but I'm just going to roll this out and I'm going to stay fairly greedy with it. Now you can see something is happening to GameStop's IV because at a higher price, I should be able to get more premium if all other things being equal. But I sold the 26 last week for $1 and I can only sell the 26.5, which is just under the share price, for 80. Now this is still pretty decent. Actually, that's not a fair comparison because the price is almost 27. If GameStop was trading at 27, then I'd be right at 27 with the dollar, and getting $1. So down slightly, but even at 26.5, this is about a 3% return on capital for a week. So I'll just keep going. Just going to keep running the wheel on this one. If the price drops below 26.5, I will be assigned 100 shares, and then I will just go to step 2 of the wheel, selling covered calls against 100 shares. As a new options trader, you'll probably want to keep a trade journal. These videos and my posts are, I guess, kind of like my personal trade journal, but you'll probably want to keep a spreadsheet too. Like you should have a line in your spreadsheet that says, and you can go to In the Money's channel on YouTube. It's probably, I don't know if you're gonna be able to find it. So it's one of his covered call videos or his wheel video, but he has a link to a spreadsheet with some formulas that will help you calculate your true cost basis. Or you can just build a spreadsheet of your own, and you'll want to put, you know, I sold the 26 put last week for $1, and then I just bought it back for $4, right? So my net profit was 96. And then, the next line in the spreadsheet, sold put in GameStop 26.5 strike for 80 cents. And then let's just say that the price of GameStop drops to 20 and I get assigned. I'm going to pay 26.50 for it, and it's only going to be worth 2 grand. And so it looks, on as far as the exchange is concerned, my cost basis is 26.50, but I can take the $1.80 that I got paid and subtract that from the 26.50, and my true cost basis would be more like 24.70 or something. And if that's important to you because now you want to make sure that you sell that's the 25 strike, just to make sure that you don't sell at a loss, that's all reasonable calculations that you should make. But it's going to give you an in your face kind of history of the effectiveness of your trades as well. But at this point, I'm just kind of like, this is all just automated for me now. So kind of just trading on autopilot. But things like a trade journal, you can even write almost like a diary, like, this is what I was thinking when I made this trade, 3% return on capital. I'm fine holding the stock. I'm bullish because they're a Bitcoin treasury. You can put all those assumptions in there and then come back and read them 6 months or a year later. And it's like, okay, I'm losing money because I made this mistake, or I made money, but I could have made more if I had done this differently, things like that. All right, so strategy. I've got 1,100 shares. Okay, that was annoying. The market's conspiring against me. They don't want me to make my trades today. All right. When I started the video, I was like, "Hell yeah." The price was like 309 and I was like, "Fucking nailed it." Alright, so I got 1,100 shares. I sold why do I have oh, yeah, 5 and 5 is 11, yeah. So I sold 11 covered calls. Some of them are farther out, but I've got 5 of these today. And so when I sold this for 950, I'm thinking, "Oh, okay, 3% return on capital." It was like 3% out of the money. But you can see there's some friction here. So I'm not really getting 3% because I have to buy this damn thing back for 385. So that drops my profits down to $6. So I really captured 2% returns for the week. Let's do that. Same thing with the 325. So I'm keeping almost all of that though. So let's close these bad boys. These 5 have been open for 6 days, so I probably won't roll these for at least another week or 2, and it would cost me almost what I paid for it to roll it anyway, so that just doesn't make any sense. But that gives me 5 options to play with, or, 500 shares to play with. And you can see that since I took those positions off and there wasn't much data left anyway, now I'm losing 480 bucks a day on this account unless I add some covered call positions back in. Now I could go out to 45 days to expiration if I wanted to, and each time I do, I would add in about 27 theta, but even with 5 covered calls, that's not gonna turn this into a option selling account. That's only gonna be like a 150 theta, so this would still be money would just be draining out of this account. So if I repeat the procedure here and pick out some weeklies, and I've got 5 of them. Ooh, that's unfortunate. I might not even be able to come up with enough theta to turn this positive. Is that true? Ivy rank might have contracted significantly. Yeah, because even if I sell these at the money, theta is only going to give me 5 times 7, about 350. That's a bit of a pain. So Ivy rank was that much higher last week? Let me see here. Yeah, I guess it was. All right, so I've got choices to make. Do I just go ahead and sell 5 at the money and do the best I can, or do I potentially roll some of these down? I could roll these out for a week. I wonder if that would improve my case. So May 23rd, 36 days to expiration. What do I have? The 375s? That's 33 theta. If I roll out 1 week, the 375s are really only 32. Yeah, it's not giving me much at all. So that's not going to help me. I don't like it. but I think that's probably the best I can do. So if I go about 3% out of the money again and sell the 320s, what can I get for that? That's about 2.5% return on capital and about 3% call away value. All right, I'm just going to go for it. So I don't like that this is still, I've got negative theta here, but might just have to live with it. The only way that I could fix that situation, see, are these ready to roll? This might help slightly. To the 450s. Yeah, that's not much. But I can roll it out for a small credit as well. So let's just go ahead. And the same with these. These have been open for 20 days. So let's roll them out to 43. These were the 400 strikes. Let me just make sure I'm doing this right. 250 strikes worth 123. So as long as I get to the 375, I'm good. So the 400 strikes are reasonable. No insta fill. Let's roll this down a little bit. A little bit more. All right, let's see. Okay, so pared that down a little bit. But I'm thinking that's about the best I can do. Yeah. Unless I want to take off some levered positions. Like I could close instead of rolling these out, I could just close a couple of these long calls. All right. Kind of don't like it, but we'll go with it. All right, I dumped all of my Julys, right? Yeah, I already closed those out. So I'm working on the Septembers at this point. And with my with my net negative theta here, I kind of can't justify buying more leveraged positions as much as I would like to. So I think I'm going to take the 10 grand. Should I add to my Tesla position? It's not going to help my theta very much because, well, it's about double. 16 positive, 8 negative. Interesting. All right. I do want to end this cycle with like 3,000 shares of strategy. So maybe I'll just take the 10 grand and buy shares. Let's see, settled cash balance. I'm not sure what the difference is. Let's go ahead and buy 30 shares. Is that 10 grand almost? That'll work. All right. I think I'm done with MSTR in that account. Performance covered calls got 43 days to expiration left on it, so nothing really to do there. I think I'm good. All right, let's check the chats real quick. Third place says, third place math. By the way, IMST rolled all of their covered calls to the 350s on May 16th, 1 month out. Those aren't bad. Yeah, I'm glad they did that. I was like, wait a minute, why are their DTEs so short? How do you label those spreads? So you have to have the group by set to custom, and then you just highlight whatever you want, and you can either right click it and do group positions, or you can hit actions, group positions, and then just name it whatever you want. Dion, thoughts on the Bitcoin M2 correlation with the 108-day lag? I don't know what that is. Let's see, dude, face earnings to Tuesday at the close on Tesla. That's a good call out. Appreciate that. So earnings Tuesday. A lot of times I'm tempted when there's a potential for stocks to just rip. I guess I'm gonna have to be watching out for Strategies earnings call. Was it gonna be beginning of May? Sometimes I'll take these covered calls off, but I don't really mind. Like if Tesla, rips to 300 a share or something overnight, that'll be fine. That just means my strikes get threatened and I close this position and this position together and congratulate myself on a job well done. I do take off my MSTR covered calls. I was eagerly anticipating FASB fair value accounting, thinking we were going to smash S&P 500 inclusion, but it looks like that's out of the cards now. But I'll probably still take them all, just out of superstition. All right, so I've got covered calls. It's actually worth more than I sold it for. It's only been on for 9 days. Nothing really to do here. I probably won't add a covered call to this portfolio until strategy hits 325, 350 maybe. And Tesla's just cruising along. Nothing really to do there. All right, this is the allowance. I already went over the credit spread with Tesla, and I already set it to automatically fill if I can buy it back for half of what I sold it for. So this may actually fill while I'm not looking. Same thing. I've only had this on for 3 days. Nothing to do here. All right, this is the challenge account. This is one might be the one that I have to make the most tweaks for. So unfortunately, I'm not going to be able to turn this into positive theta with just this 100 shares. So I think I'll probably will have to close this, unfortunately, just to get enough juice into this account. Unless I peel off one of these. That's only 16. Yeah, that's not going to help me, I don't think. So with the high implied vol last week, I was able to still maintain positive theta. Um, what's the most I can get at the money? 71. So double that's going to give me 140. Yeah, I'm still not going to be able to make it happen, unfortunately. So I may have to sell some of my Oh, you know what? I have to close these. This is going to help me. This is going to help big time. So let's talk about it. This account has done very poorly against MSTY, but it's not because like these strikes were bad or these poor man's covered calls were probably chosen poorly. So you can see I bought them for 13.5. They're only worth 10, you know, 10 grand now. And so that's hell, that's $35,000 in capital destruction. It's an unrealized loss. But just from these poor man's covered calls, the account's down 35 grand. Now, I've been making, whatever return on capital with the covered calls against them ever since. But the price was like 375, 400 a share. And so I thought that these 300 strikes were pretty safe. And clearly I was wrong because the price went down to 250. So I would have done much better if I had paid more for like the 200 strikes, maybe, or at least the 250s. They would have still gotten their asses kicked. But they would have held on to their value a little bit better. And so really, I've been collecting tons and tons and tons and tons and tons and tons of premium. Like if I hadn't collected any premium at all, I'd be down like another 50 grand probably. But instead of taking that 50 grand or, whatever, and buying like another 100 shares, 150 shares with it, I bought these. I can't remember if I had June's too in this account, but I was buying these short dated, short dated for me. Short dated for some people is like 2 weeks, but short dated for me is anything under 180 days. And so I was buying these Julys back 84 days ago, and my average price is 755. So they're down like 90%, right? And let's see, 10 of them down $700 would be 7 grand times almost 4. So that's another 28 grand that's hemorrhaged from this account on top of the 35 over here. If I had plowed them into shares, my average cost basis would be somewhere between 250 and 375, right? So let's just say 325. And so I'd only be down about, 10, 20% if I had purchased shares. But me and my infinite wisdom and being greedy, and like I really wanted to like wipe the floor with MSTY, right? I wanted to kick their ass, and just drag them, right? So I thought, oh, I'll add this leverage. And when strategy rips to 450 all-time highs again, I'll just be like wiping the floor with these guys. And of course, price didn't go up, the price went down. And so leverage is great when the number's going up quickly, but it sucks very much bad when the price is going down. So I basically lit this $28,000 on fire, right? It did me absolutely no good whatsoever. And, you know, now I'm pinning my hopes on the Septembers. And if in 3 months, if we're still trading at $300 a share, then I will have lit all of this money on fire. So I don't know if I'm just sticking to the strategy or if I'm just revenge betting at this point, but I'm gonna stick with the plan for now. All right, so that gives me a sigh of relief because now I only have to find a covered call that makes up for 11, negative net theta. And it also gave me a little bit of buying power to spend. So if I go ahead and get two more of the Septembers, I'll have an even 20. And so I'm basically rolling the Julys out to September. Not quite. I could spend more, but I don't want to put myself in a bad spot for trying to keep up with this negative dragon theta here. So I may plow the rest into shares. Let's see. But I can be, since I only have to make up for negative 27 theta, I can be pretty conservative with my covered call for this week. I could even go to the expected move. Sure, why not? All right, so this barely qualifies as an option seller's account, so this might be somewhat of a cop out, but I think it's the best I could do. I mean, I could squeeze a little bit of extra theta out of here if I rolled these 9 out to 43 days to expiration, but yeah, that's like the credit would be so small. I think I'm just gonna stand pat here. And then with my 2 grand, because I don't want to add more drag to the account. I would love to buy leverage here, but I don't think that would be in keeping with the spirit of the challenge, right? If I'm competing against an option seller's account, I have to have a positive theta number here. So I'm going to hold myself to those rules. If I was just trading in my own account, I mean, clearly every single one of my other accounts, I think, had negative theta here. So I'm willing to take some more risks on my personal account than I am with this one. So I'm kind of enforcing that rule on myself, really. So with 2 grand, I can get six, almost 7 shares. Let's buy 6 shares. This is going to give me, I'm basically just treating this like a drip, you know, and adding more exposure to strategy. This is kind of the opposite of what MSTY is doing, right? So people talk about the return of capital, not return on capital, which is how much money you stand to make based on a trade. But return of capital, meaning I watched their video how they explain why what they do, and it does make sense to me. I'm still kind of not quite convinced. But what they might do is actually pay out all of the premiums that they collected as a dividend, even if the price of strategy went up and they have an unrealized loss against rolling it, or if the price went down and they have an unrealized loss on the long underlying positions. So like regardless of any of that, they're just returning all of the premium. And so their net asset values can go down over time. And that's been one of the things that people have been critical of YieldMax for is NAV erosion in their products. But I think somebody shared a chart that maybe strategy MSTY didn't have the same kind of NAV erosion as some of the other tickers. But maybe I shouldn't even have said that because I'm not sure if I remember it exactly correctly. But by buying more shares, I'm basically doing what a drip investor would do if they were paid a dividend and then bought more shares of Misty. So I just made 2 grand in buying power and I just plowed it all into more shares. Now the magic really happens, and you'd have to have a shitload of money to do this with strategy. But if I was able to sell enough covered calls that the premium added up to $31,000, then I could buy another 100 shares of strategy and sell an additional covered call. And that's when covered call trading starts to turn into like a compound interest machine, because every week I'd be selling more covered calls than I sold the week before. It's much easier to do with something cheaper like the mining stocks, right? But anyway, I call that reaching critical mass. Like once you're selling enough premium that you can actually buy another 100 shares of something every Friday, then even if your overall portfolio is going down, you're actually increasing the number of covered calls that you're selling every week. So that's kind of a cool thing. But that's assuming you don't need to take out any money for, you know, paying the bills. And actually, I need to think about that. I probably am going to have to pay some more bills soon. So probably shouldn't have spent all that money on new positions in the main account. All right, so I've got net positive theta here. I've got one weekly covered call. Um, not really collecting a lot of premium, but keeping about not quite 10% call away value in here. Maybe 7. And it'll be another week or two before I roll all these 36 DTEs. So I think I'm good to go here. Again, I would love to be just super greedy and, sell these 9 shares, get 2,700 bucks, and then just ape into like 7 or 8 more of these damn things. But if I do that, I'll turn this into a negative net theta account, and that's not quite in keeping with the spirit of the challenge. All right, I'm going to quickly jump on the 5K account. I think I've got some decisions to make here, unfortunately. So these poor man's covered calls that I have set up, I've got my longs that are just barely in the money. Again, I chose very poorly with these 300 strikes. They've lost a shitload of money, probably at least 50%. But since I don't like to hold long calls under 90 days, I'm going to go ahead and deal with these now. And that means that I'm going to have to sell at least one of these, buy to close one of these shorts. So I think I'm just going to do it all at once. These are, since I don't have enough buying power, I'm going to have to do this all in one shot. So these are 5, 16. So I can actually, if I had buying power, I could go into those options and just close them, right? But since I don't have enough money to actually close the shorts, I got to do this in a little bit of a sneaky way. I think there were 380 strikes. Yeah, so I've got 2 of them. So since I sold them to open, I'm just going to pretend like I'm buying these options. So I can't buy them to open because I actually have 2 shorts. And then the July 18th ones, I have the 300 strikes. So I bought these to open, and so now that I have sell call selected, if I place this, I'm basically just closing out all of my positions. Let's do 2 of them. Probably have to roll this down for a smaller credit. Let's do 50.25. That should fill. Yeah, okay. So that gave me, 10 grand or whatever. And so now, unfortunately, I can probably only afford one poor man's covered call. Let's see, 250 strike, 0.75 delta. That seems reasonable. So I'm going to buy that one and go out to 45 days to expiration. Again, to get me in the ballpark of a safe short strike, I'm going to add the strike of the long to the value of the long. That gets me to 360. So as long as I'm selling the 360 or higher, I should be pretty close. So I'm going to go to a little bit less greedy of a position. I'm going to go all the way to the 400. And I'll probably have to roll this up and pay a little bit extra. Let's do 99.75. There we go. All right, so I kind of recalibrated that one a little bit. In general, with poor man's covered calls, I like to buy leaps, but with a small account, I can't afford it. So I'm cutting a leaps in half and going to 180 days. They're saying they want me to spend like 5 grand in margin, but that I really only have $300 in cash. So let's just go through. I'm basically running the wheel with these mining stocks. So close it, pay a buck, view all options. Next week, sell call. I generally go about 10% out of the money. Some people gravitate to a particular delta, but as long as I'm getting like 1% return on capital, so this would be about 1.5%, I'm generally pretty fine with it. And it's funny because when I talk to TradFi option sellers, the idea of consistently getting 1% return on capital every single week is like they think you're like talking scam shit. um, but these stocks are highly volatile, so they're used to you know they're used to buying Apple and Amazon and shit like that, and you can just look and see that these mining stocks, what, it was up to 38 and then down to freaking $2.50 during the bear market, up to 20, back down to 8. And so, you know, if you're collecting a bunch of premium here and then the price of your stock drops by 50%, a lot of the TradFi people can't handle that. They can't stomach that kind of volatility, but that's what justifies such high premiums. The iron calls were worthless basically yesterday. Same with the riots, so I rolled them already. So nothing to do there. Wolf has cratered so badly. I bet my cost basis is like $6 or $7 a share. Yeah. So these have collapsed by like 60% in value. And trying to get premium on a stock this cheap is really brutal. It's really hard. So I'm kind of tempted to just cut bait and take the loss. But I mean, it's not the end of the world. But even if even if my shares get called away at $3, that's a 50% haircut on what I paid for them. So I'm barely like squeezing out a few cents of profit. $14 out of 45 days to expiration, and I still have to choose a strike 50% below my cost basis. It's kind of a pain in the ass. So these types of losses are possible. This is definitely not an I win button at all. All right, got my strategy rolled out. I got all my covered calls rolled out. Again, I have to go ahead and take a haircut on all the July 1080s I bought. Average cost on these is $327, so I'm losing about, what, 75% of that? Oh, not one. I have two. Wait, did I have two or three? I'm doing this one at a freaking time. Oh, God. Wait, how many do I have, for God's sake? Got one left. All right. I literally did that in the least efficient way possible. All right, they gave me a little bit of cash to spend. 558. I'm going to go ahead and add another September 1080. It's my average cost, 565. Okay. So I guess I'm dollar cost averaging into this. and my lonely little riot call. So some friends of mine wanted to get into speculating on some options. And so right around when Bitcoin was coming off all-time highs, we decided to buy a riot call for like 300 bucks and now it's worth 20. So, real happy about that. But, you know, Bitcoin roars back to 150 or something. We might be able to dodge a bullet on these things and make a little money or at least break even. All right, that's all the positions in this account. All right, let's check chats and call it a day. All right, dude face, in the past, Tesla runs up into earnings, but sentiment is so low. We'll see. Last earnings was similar, and the earnings call was bullish, so it ran a little after that. Didn't hold, though. Yeah, it's going to be interesting to see what the premiums look like after Ivy Crush. Might be some good calls he's selling weren't as lucrative as they could be, and he hinted that if the environment is not suitable for selling calls, it might be an opportunity for buying them. It was kinda like wink, wink. So, um, yeah, I mean, in general, low IV environment is ripe for buying calls. Kunal, does this mean you're done with your 1080? Seems like a great way to continue burning money. I am not done with them. Uh, yeah, I've been eager to light more money on fire. So I've got 20 of the September 1080s. They're down about 10%, uh, which is a lot better than being down 90%. But yeah, so same deal though. In 3 months, in July, if strategy is still trading at $300 a share, then I'll be, you know, selling these for 40 cents a pop or something, right? Well, let's just see what what they would be worth. So the Julys, the ones that I just unloaded, sorry, no, yeah, the July 1080s. What are those worth? Yeah, 85. Yeah, I'll be selling them for peanuts if strategy doesn't move. But if it does, we can buy Lambos. Joshy T, not sure if I said this before, but I appreciate your honesty and transparency. Not everyone is man enough to own up to their mistake. Yeah, I definitely learned big time in November because as a native option seller, like buying calls and hoping, crossing my fingers and hoping the price goes up was kind of a foreign thing. So I let FOMO get the best of me and I did not see what I should have seen, I think, kind of plain as day, and didn't take my profits. And then what I should have done as well is instead of like here, December, January, as we're still kind of correcting from this IV spike, I shouldn't have been eager to buy more leverage and long calls here because IV continued to drop as well as the price. So that's kind of like a double whammy. When you buy leverage, if the price drops but implied vol goes up, you might be able to break even a little bit. Or if the price, stays the same or doesn't really drop, maybe it goes up a little bit. But if IV collapses on you, you're still kind of treading water. But when IV collapses and the price collapses, it's a double whammy on your long leverage. So, um, yeah, had a really big opportunity to keep a bunch of money in my pocket and failed miserably. So now I think I'm starting to learn both sides of the option trade a little bit better. I started trading options in May 2020, but for that whole, basically the 4-year period, I was just selling options. The only options that I bought were the in the money ones that I could sell covered calls against. So it was like 100% covered call selling, basically, and some spreads. But yeah, Quant Bros 1 kind of turned me to the dark side of the force, and I was like, "Oh, you can actually buy calls and make a bunch of money." Like I didn't really know that was a thing. I thought everyone that bought calls lit their money on fire, right? Because I was used to taking their money, selling covered calls. Dude face, another interesting thing they do is build out the long positions that are above the strike sometimes. So this month it would be the 330 long and selling a put, which would give them a credit. Yeah, I was I'm gonna have to really wrap my head around it because one thing that he said, and I'm sure it's probably true if I think about it a dozen times in a row, but he was saying that the synthetic longs give them a little bit of flexibility when their strikes do get wrecked. Because for somebody like me who owns, let's just say 100 shares and I sold this covered call against it, if the price goes up to 350, I got to pay that $1,500 to roll it. To prevent my shares from getting called away because, I want to keep selling covered calls. So I would either have to dip into my capital to pay that 1,500 or, let them be called away and I'm kind of asked out. But the way that he described it is if they have the synthetic long at the 300 strike, since the long call at 300 is now deeper in the money, they can roll that up for a credit and use that credit to pay for rolling the call. And I can't stop thinking about it. And I kind of see how that makes sense on paper, but it's like, it feels like, there's some sorcery in there that I don't know if that just puts you at more risk for the price dropping back down. So it'd be like you sold your shares at 300 and you bought them back in at 330, and then if the price goes down to 300 again, now you've lost an extra 3 grand. So I don't know. Maybe that's why they they do have some NAV erosion over time. So anyway, yeah, they claim that there's some advantages to using the synthetics, but I know they have to use the synthetics because of I think it's the IRS laws where I know there's some other code 17F or something that regulates diversified ETFs, or I guess in this case, is this an undiversified one? Anyway, but there's also some IRS code I think that says they can't have more than 25% in an asset. So some combination between the IRS rules and the rules on ETFs means they have to use synthetics. Joseph, your strategy for the competition account is basically what I'm doing with iBit in my Roth. All right. I hope we both do well. Kunal, does that mean you're going to start stacking December 1080s or further out 1080s once we get closer to those dates, assuming we aren't running the tables? Yeah, good question. I'll probably stop stacking Septembers like halfway from 180 to 90, right? Like if I'm gonna make a decision on these when they're at 90 days to expiration, I'm not gonna buy some more at 95 days to expiration and just hold them for a week. That's probably not gonna do me much good. So halfway between 180 and 90 is 45 days. So yeah, around 135 days, I'll probably stop buying 1080s. I'll stop dollar cost averaging into the Septembers. And yeah, absolutely. Then I'll just move out to whatever, December. Yeah, in 45 days, this will have 100 and they'll have 200 days left on these. So yeah, probably December's. Dude face. They also have a preferred margin rate as well. So another handicap you have to I know. I was like, holy shit. They were talking about only paying like 10% of the options value. It's freaking ridiculous. Like for example, if I wanted to buy a share of Strategy, oops, not 100 shares. Good lord. It's still costing me 2/3 of the price, right? So they're giving me like, I have to pay 66%. They only have to pay like 10%. So buying a share for them would be like $30. Fucking ridiculous. So yeah, so they have that kind of advantage as well, but then again, that's kind of a wash because they have about 90% of their portfolio, I think, is in treasuries. And so for them getting that 10-to-1 margin, that's how they end up being 100% exposed to the fund with their covered calls. So it's a bunch of freaking shell game, witchcraft trickery, but it kind of just works out in the end anyway. All right, we are all cut up on the chats. Thanks everybody for tuning in. Have a good 3-day weekend if you are lucky enough to get one.